Can you hear? Oh, there we go. Okay. So I'm CFO of Masters Fund. We invest in women-owned startups at the first revenue stage. We provide non-dilutive funding. We are looking for companies. But now I'm going to ask you all to introduce yourselves.
First, let's give it up again for Ryan McRobert from Fenwick. This guy does all my legal work. He's awesome. Great. Thanks for sponsoring. Kill me for that shout out. It's okay. So I'm Anthony Bontrager with West River Group. We're a multi-asset manager here in Seattle. I run their technology practice, which encompasses both our early stage venture fund as well as our fund of funds practice as well. We manage roughly about $1.2 billion. And if you guys, anybody's played Topgolf, raise your hands. Topgolf? Great. We're the guys who created that. Our CEO was the person who ideated the whole concept behind Topgolf and has been his chairman for the last 15 years. So that's our claim to fame, and there you go.
Hey everybody, I'm Sabrina Wu. I am principal at Madrona. I've been here since 2021. For those that don't know, Madrona has been around for about 30 years now. We are early stage venture capital firm investing from the seed stage all the way through Series C. Currently investing out of our ninth fund. I think we might dig into a little bit more about the fund structures at the next question, but that's the high level on Madrona. And prior to joining Madrona, I was at a later stage fund in the Bay Area doing mostly buyout and growth equity investing, and was based in San Francisco.
Awesome. I'm Jake. Good evening, everybody. I am an investor at Tola, and Tola, we're a Seattle-based VC. She wants to see founded us. We're female-founded and have been around since 2010, so doing this for 15 years now and investing out of our third fund. As far as my background is concerned, I started my career at Microsoft, so as part of the finance education program, I got to do a bunch of fun things when I was there. Spent the bulk of my time in their O365 business group doing acquisitions, partnerships, and product planning, and then went to a company called Qualtrics and led revenue OpEx planning for their CS line of business, and then made the jump over to venture in 2019.
So we're going to kind of follow a similar format to before. So could you talk a little bit about your investment philosophy, thesis, check size? You've kind of given a brief overview, but you can say more about that.
Sure. Yeah, so as far as Tola is concerned, we're entirely enterprise and B2B scenarios. Everything we do these days has a pretty strong undertone of AI to it, whether it's infra, app layer, data layer, etc. It's a big part of the narrative, and we're talking to founders as how to think about this world of AI evolving and impacting what it is that they're building. For us, we're typically writing $1 to $4 million checks at the pre-seed and seed, typically about $10 million or so in the Series A. And we're investing out of our third fund now, so we're about $700 million AUM. The last fund was $230, and a big part of how we think about deploying that is following on and making sure we have proper funds set aside for allocation post first check. And so we'll typically deploy about 50 to 55% of any fund into new investments, and then we'll reserve the remainder for following on and continuing to grow with our companies. And then the other thing that I would say is that there's 9 of us that do the investing. We're very consensus based as a team, high conviction investors, and so we'll typically do a smaller number of deals per year, but deals that we're leading. So it's usually about 6 to 8 deals per year.
Thanks. So yeah, as mentioning earlier, Madrona's been around for about 30 years now. We are Seattle and Bay Area based firm. We invest at the early stage, so seed all the way through Series C. Occasionally we'll lead a Series D as well out of our early growth fund now. Our latest fund is about just under $700 million, and that's the fund that we're deploying capital out of. I'd say on the smaller end, we usually write checks of $1 million, and then on the upper end, usually 10 to 20 million. We also reserve capital for follow-on investments throughout the life cycle of the company. In terms of thematic areas, we are very thematic-driven investors, so we like to dig into areas that we feel like we can roll up our sleeves and really help the companies grow. We are tech-focused, but we invest broadly across the technology spectrum, so we're doing everything. A lot of our investments today are mostly AI, ML-driven, as you would imagine, but we also do things beyond that in the cloud, dev tools, infrastructure space, and then we also have a biotech practice, which is the intersection of life sciences and machine learning. So that's the overview of that.
A bunch of POCs stacked up there. We think that's the best point for us to come in and add value as investors and advisors to the companies. Our entry checks range anywhere from 500,000 to 5 million. We have a very robust reserve policy. We typically pro forma investing anywhere from $8 to $10 million over the life of our hold of our investments. Given the firm's balance sheet and the different capital pools that we have available to us, we actually have the ability to create co-invest vehicles and stay with our companies into the B, the C, and the E range. So we like to live long term with our portfolio companies, make sure they get to get to the promised land, and make money obviously for all of our investors.
So I'll talk a little bit about Masters Funds. What we do is we invest in women-led or owned companies, majority, and we look for companies at the initial stages of revenue, and similar to where they're getting ready to scale. And we focus on tech companies primarily. We steer away from inventory-driven companies. Generally, we want to invest in companies that we feel are doing something good. So we have a bias towards that. Our check size is $100,000 on average for the beginning, and it's a convertible note, but it's a redeemable note, so that the founders have the opportunity to buy that note back at a multiple over the next 3 to 5 years. So in the end, it's non-dilutive, which so that's a big differentiator. So we are interested in talking to you. So let's talk about companies that you've invested in, the ones that really, pick one out that's really you're excited about.
I can start. Well, it's hard to pick one. I think as the panel was saying earlier, no one has a favorite child. I think that's true. I can share a few investments that Madrona has made over the years, and then one of my favorite investments that I led last year. So Madrona was early investors in Amazon. Obviously, we all love and use Amazon, so that was a really exciting journey. We're also early investors in companies like Snowflake and Rover, which if you guys have a dog, probably have used that service over the years as well. So continue to make really great investments. I'd say one that I'm particularly excited about that I invested in last year is a company called Shaped. It is a recommendation system, search system. So think about, the world is pushing towards more personalized content to you, be that if you're on a marketplace, you're trying to shop, whatever that is, they will actually help power the back-end system, set up the models for you, connect to your databases, and make it easier to search and do recommendation systems. So that was a company that's based in New York. We led the Series A and really excited about what they're building.
Sure, I can go next. You can't get a favorite, so I'll echo that. But I do have a favorite, and it's called Clarity. And so Clarity, one of my focus areas for Toll is thinking through back office automation scenarios, and a role within the enterprise that I've really sort of centered around is how to think about that with respect to finance and accounting teams. And it really presents itself as this perfect intersection of very document-centric workflows that are human-powered, independent, and that's a fantastic candidate for automation with respect to what we're seeing in AI and ML these days. And so Clarity's really right in that wave. And so this company was originally founded back in 2017 at MIT, Harvard grad. And Andrew, who is the CEO, was an attorney prior to founding Clarity. And his basis was saying, hey, I want to automate my entire job away, and I hate doing any doc review. And at the time, it's hard to believe this now, but legal was a very difficult vertical to sell to, and they were really skeptical of technology. So they said, let's pivot to a different use case where there's plenty of documents, and so they landed on finance and accounting. And so, the thesis for the company is to think about automating the entire creation of the P&L and your financial statements. And it's just been really incredible to see the growth of that business, but then also the growth with the tailwinds that we're realizing now with what's happened with generative AI, and you're starting to see enterprises begin the procurement cycle for true automation solutions, and it's starting to permeate throughout the enterprise. And seeing the tip of the spear being a finance and accounting use cases for me exciting, and it's very core critical workflows. And so Clarity's doing some really great stuff there. We were able to lead their Series A. They just raised a Series B this summer, and so very excited about that company.
You know, I hate this question, only because I'm going to say some company's name and everybody else will get messages tonight. Dude, what the fuck? Where was our name? Right? So for anybody in the audience who I've invested in, don't take it personally. Don't send me emails. So
Force me to do it.
Yeah, I'll be getting flamed all night. The company that I'm really excited about is a company called Groupit, based here in Seattle. We led their seed round last year in partnership with Cercano, Ascend, and a number of others. And what Groupit does is, if you're using Team, you're using Slack, Jira, GitHub, etc., you've got these massive knowledge silos throughout your organization, right? And those silos really don't allow information and insights to leak outside of it. What Groupit does through partnership with these companies is it breaks down those silos, and it allows an organization, specifically the key stakeholders in the organization, to basically crowdsource knowledge from the edge of the organization and drive actionable insights back leveraging AI and machine learning to do so. And what this really allows organizations is basically find things like leakage in sales, product feedback that they otherwise weren't getting quick enough to basically iterate and get new patches out or new product features and things like that out into the customer's hands. And as a result, they've been able to demonstrate real ROI back to the customers within 30 days or less. Customer base includes Siemens, Dell, Home Depot, you name it. We led this round back in 23. Last year alone, they doubled their ACV and tripled their ARR. Their founding CEO, Tammy Savage, is an absolute fucking rock star. I love her. She's just one of those CEOs who gets it, is super, super collaborative, not just with the team, but with the board and the rest of her investor base. And it's just truly a delight to be able to work with someone like that and watch her grind out and turn this company into a success. And so that's what we like to do. And specifically because it's AI and ML focus, it's where we typically live and breathe for the tech sector for West River Group. So it met all of our themes, checked all of our boxes, you name it. And obviously, to the extent we can support female-led companies, we absolutely want to do so. And this was a great way for us to do that.
So you look at hundreds of companies over the year. So when
I had hair when I started this job.
You didn't. So when you're first meeting a company and founder, what are the things that you look for that are going to get you excited to go further in your conversations with them?
Wow, that's a great question. So I guess there's probably, I think, 4 things I typically look at. You guys hear me?
Or anything.
Keep it up here? Yeah.
Also, anything that's a negative to you.
Yeah, I like curiosity, candor, passion, and then finally, I think is probably the most important, just self-courage. And what I mean by self-courage is, look, hands up for everybody who's a startup founder here. Awesome. Guess what? We all know, shit happens, right? Right? You wake up one morning and you're like, holy shit, my POC just flamed out, or we're flashing up the blue screen of death, for our customers. Whatever, it happens. And a founder who can't basically stand back and say, hey, I don't know what the hell to do right now. And rather than dig in, kind of operate in a vacuum, and not go to your investors and your advisors and say, hey, I don't know. I don't know what to do here, right? What have you seen as investors? You see this shit all the time. How can I leverage your pattern recognition? If you don't have the courage to say, I don't know, that's a problem. Because investors don't like surprises. And so if you can simply say, hey, help me out, because that's what we're here for. My job is not to basically, beat the hell out of a founder. That's no one likes to do that, right? We want to help. We want to basically give you the tools to succeed, because if you succeed, we do. So it's okay to say, I don't know. It's okay to ask for help. In fact, your investors, your board members, your advisors, they want to hear that. So that self-courage, that self-awareness, for me, is critical when I look at a team.
Yeah, I think for me, one of the biggest things is intellectual curiosity. So I think that the startup journey is a really long and hard one. You're always going to, as Anthony was saying, run into days where it's very challenging. Things may not go the way that you want it to go. And so you have to continue to be curious and learning, following your customers. You have to be willing to pivot. You have to be willing to take that feedback and really iterate on what you're building. And I think if you're not intellectually curious and don't actually go seek the feedback from those customers, it's a hard journey. So that's one. I think also grit is another, kind of goes back to just it is a grind, and I think it's glamorous in a lot of ways. As we, it's easy to make it seem all fun in like in a parent setting, but in reality, it's a really really hard journey. So I think having grit is another really important trait. I think when we look at businesses, we look for founders that have what we call founder market fit. So that means, why are you the right founder solving this problem? What about your background makes you a great CEO/founder to solve the problem that you're trying to go after? And I think that is incredibly important and will help differentiate you from other companies and other founders in the long run as well.
It's hard to add to that. You covered all the bases. So I mean, candidly, my 3 word founder market fit, and then grit, but I call it sort of stability to run through brick walls. Startups are really hard. It's a 15-year overnight success, and so you're going to have more bad days than good, but you're going to be able to get through the bad days. And so in that, I think a founder's ability to just be open to coaching, open to teamwork, open to guidance, like that's something that we test for. Things that we often don't talk about as a team, but we view as table stakes are integrity, honesty. Like, can you trust this person? There's a lot of assholes out there, and if you can choose to not work with an asshole and associate yourself with someone who's just frankly a whole human, like we try and avoid that. And so there's things that are table stakes that we want to be true for that we're partnering with, but those are the 3 things that I think we look for most.
I mean, it's a lonely seat being a founder. I'm sure as all of you know, right? It's lonely. You don't know who you can talk to, and the stress is brutal. I've been a 2-time founder myself, so I know what you've been through. So just like I said, make sure to be able to ask for help. That's what the investors are for.
And one of the things we look for is, to that point, it's a very long and lonely road. So we look for who they have with them. We tend not to go with solo founders. We would rather have a team or a couple of people. So thinking about that, what do you think is more important, the team or the market? Obviously, both, but
I would choose team every day of the week over market. Markets will change. Things are going to evolve. Not every founder can roll with those changes and be able to adapt. And, the reality, we see this a lot because we're investing early stage and partnering at the inception of a lot of founders' journeys. Most companies pivot. And whether it's a soft pivot or a hard pivot, like there will be changes along the way. And so, from the perspective of an investor, you're ideally going to be looking at markets that you have a thesis around, you're excited about, and you believe the long-term vision of what that will become. But I would choose a strong founding team every day of the week.
Yeah, I echo that. I think team is incredibly important, especially at the earlier stages, seed Series A, especially because you're often pivoting. I think as you go a little bit later stage, as I mentioned, we do some Series B, C, even D investing. Market does obviously play a bigger factor into that as you're thinking about the growth potential of the business. If you're entering at a later stage, then the market potential is obviously a little bit more important at that point in time. And although you are continuing to add new products, you generally have a direction, you found product market fit. So I'd say market tends to be a little bit more important as you reach the later stages of the business.
Well, yeah, what you guys said. Tom Cruise is famous for a quote. He says, "Look, I choose good movies, but I make the characters great." Right? So you can have a good market, but unless you have a great team, right, it's not going to get to where you think it's going to go. Because, like you said, things change, right? And you may have to pivot, do something else. A good team, or a great team rather, will find a way. That's Doug Leone from Sequoia Capital said the same thing. He goes, a good team will get you where you need to go. It may not where you thought you were going, but they will get you there.
So you're investing in people in the day.
100%.
the other thing we would look for would be ability to delegate when necessary and build a team. Because a lot of people come into contact with founders where this is not, that's not going to get you to the place we want you to be. So understanding what they need when they need it and getting the right resources and people in place and the talent. So let's talk about valuation. How do you think about early stage valuation? What do you look for when you're considering thoughts?
Sure. I can go first. So I think valuation is also one of those things where it depends on the stage. And I think the earlier panel was saying that it's a little bit of a, there's no magic formula. That's probably the best way to put it, especially at the seed, pre-seed and Series A. I think that there's some ways to think about the business, and there's ways to think about, for founders in the room, to think about comparables, which is often what investors do. So what in another company that's very similar to you raise at? What are the kind of standard terms that you might see YC structuring safes at? Those are some maybe guidelines or principles that you'll hear people refer to, especially investors, that they'll kind of benchmark against. But there's no real magic formula. I think that it's hard to pinpoint it to one thing. I think that if you maybe are a second or third time founder, you may be able to command a higher valuation just because you've done it, and maybe that would present itself to be such. But yeah, I think it's a number of different factors. And then as it gets to the later stage, I think that we comp against public markets. So you can look at what are the companies that are similar to you. If you're building in the DevOps space, maybe you'll look at the Datadogs of the world, and see how they're trading in the public markets, see how it compares against your growth and your profitability, and then benchmark off of that. But yeah, it's a hard question to answer.
Yeah, so for us, I guess there's two ways to look at it. At the macro level, we're fairly price sensitive, but the more nuanced answer is really this: it's how much money do you need to achieve the KPI to get yourself to your next round. Right? If you're a pre-seed company or a seed company, you've got to establish product market fit. What the hell do you need $10 million from your investor for? You don't, right? All you're going to do is basically, to do that, you need to command a higher valuation. And how many times my head said shit happens tonight? Quite a lot, right? Okay? So let's take the shit happens moniker right there, because it's going to happen. And very rarely do these companies at the seed stage actually earn their way up to the valuation when they command these larger rounds. And so a future financing risk for the investor and for the founders is very, very real. And so while we do all the analysis and everything to basically fill out our investment memo, which is pretty robust, at the end of the day, it really comes down to, hey, if I can get you enough money to get 18 to 24 months of runway to achieve these certain KPIs, and it may not be 10, it may be 5. That's really all you need, because you do a complete financial analysis on these companies, right? Take that money at the lower valuation, because you'll ultimately get to where you need to go. You'll build a pattern of success, and ultimately, you're going to really knock the cover off the ball with the valuation down the road. So don't think you need 10. Don't shoot for the big valuation. It will ultimately screw you in the end 9 times out of 10. So that's how we balance these things. But again, we do all the same research, we do all the same analysis, but really at the end of the day, that's what it comes down to. How much do you need? What do you need to achieve? And can you mitigate that future financing risk?
Yeah, I would agree. I mean, we try to be pretty sober and rational investors when we're looking at competitive deals and things to bid up. And I think the reality of it is, you can only pay up on a couple of deals per fund, and you have to be careful with that for how you think about the composition of your fund. At the early stage, I mean, there's no sort of special formula or silver bullet for how things price. Like, it's a lot of this. And, when we're having conversations with founders, we'll work through sort of their budget, right? And what do they think about spending for the next 2 years, 24 or 30 months? Like, what's the bottoms up want to look like? How much does that tell you actually need? And then if you are going to start comping, you can comp also based off sort of the dilution you want to take on as a founder. I think there's acceptable ranges of dilution at pre-seed and seed, and depending on the quantum of capital you're taking, it's pretty easy to figure out sort of what a market clearing price is for some of these rounds. But there's always going to be rounds that run and things that hit that up, and it happens.
So what advice would you give to the founders that you're talking to here? What's going to help them to think about how to be more effective with venture capital?
That's a few things. Yeah, there's like, again, there's not like a silver bullet for this answer, but when as an early stage investor and we're talking to founders, we're thinking about underwriting to $1 billion outcomes, right? Like, you have to see that vision, and as an investor, you have to be able to believe that. If you yourself as a founder don't believe that this can be $1 billion outcome, and you don't want to put in the work that it's going to take to realize that, then you probably shouldn't be talking to investors. And that's how I would say you have to think about the growth trajectory of these early stage businesses. Is you have to have sort of the idea of potential. setting that aside, I mean, I would really think about, coming back to sort of why you're positioned to win. So what's your founder market fit? How do you understand the scenario? What's your unique perspective on the market? How does that position you to, come at this with a new and unique perspective? That really teases us through. And then, like I said, we also really test for sort of grit and the ability to run through brick walls. And, these are things that you have to think about landing as you're presenting. But I would say, as a founder as well, I mean, the advice that I always give to whether it's, companies that I sit on the board of or companies in the portfolio or founders that I become friends with, as investors, we do a lot of diligence, background checks, customer calls, anything related to the market. Like, we're trying to be as thorough as possible. Founders should be as thorough as possible on the reference checks for investors and funds as well. And there's a ton that you can learn. You can talk to the founders they invested in, you can see what their style is, and also test the investors too. If you're having a conversation, it doesn't have to be in the, machine gun pitch mode where you are not letting anybody get word in. Like, you should ask the investors sort of, what's your thesis on the market? How do you think about this space? And do they have a prepared mind? And so I think there's work that you can do for also figuring out what that fits like for you.
No, I agree. And Sabrina, you actually made a comment. The whole "why are you the founder to take this company out?" Right? And I think that's incredibly important. Right? How passionate are you? How knowledgeable are the marketplace? Right? Can you have, or do you have the fortitude to sit in this lonely chair and drive this business forward? And there's a lot of soft science to determining whether that founder is that person. And it takes, again, for all of us, the pattern recognition to kind of, ferret that out relatively quickly. I also like the idea too about, having them. How much diligence should you do, right? Why are you coming to me? Am I just simply a checkbook, or do you actually understand how I view the market, the lens that I have on your business? Because this is a marriage. We're going to be joined at the hip for 5-10 years. We better have at least very much in alignment in terms of where this thing can go before that happens. If you're looking at me just because I'm basically a guy with the checkbook, I don't need investing. So that's
Yeah, I agree. I think the maybe one thing that I would add, given I spent a lot of my time investing in the applied AI ML space, is that there is a lot of froth out there, and there's a lot of hype, and there's a lot of really cool technology. And today, I think it's easier maybe to build than ever before. And so I think one thing that I would encourage founders to do is to continue to listen to the customers. Like, make sure you are solving real pain points, something that people will actually pull out their checkbooks for and pay you money, because at the end of the day, you are building a business and it needs to be an enduring business. And so I think that it's awesome to build really cool tech, but at the end of the day, you do have to be solving customer problems. So continue to figure out what that is, iterate on that, and continue to be curious.
So thank you very much. We'll open it up for questions now.
I can speak loudly if you want.
I got you.
Whatever.
We have
Okay, that's great. So what I'd love to find out is every VC I've ever talked to has a different method of deal flow sourcing. How do you source your deals? What do you look for? Do you have a process? Do you just find founders referring founders? What's your deal flow process?
It's my most unique IP, I can't tell you that.
Look, I think it's whether you're a managing director, a partner, or an associate level at any firm, right? You're doing the same thing, right? I mean, you're going to events like this, you're meeting founders, you've built a network of people who, like Ryan, for example, who brings me investment deals, or other attorneys, or other service providers, folks at Clark Newber, for example, right? That's how we get our deal flow, and it just simply builds over time. I've been doing this for 30 years, both as a founder as well as an investor, and so that network grows organically, right? And for me, it starts here in Seattle, it extends to Dubai, Riyadh, New York, you name it, right? It's just, you're just getting out there and grinding it. I don't care what level you are in the organization. If you're not grinding, you're not going to get anywhere.
I personally tend to have a thematic sourcing approach. So usually every quarter I'll think about well, not every quarter, but every quarter I'll at least refresh what my thesis is for the quarter. I'll share about that online. I'll write about it. I'll talk about it to other folks and try to meet a bunch of founders or future founders that are building in and around the space. And so, at the earliest stage, oftentimes we're trying to partner with people that haven't even left their full-time jobs yet. So it's figuring out where are there really awesome pools of talent, where are there some signals of people that may be looking to leave because XYZ factors. So we'll look that way. And then all the traditional things that you think of, LinkedIn outreach, cold emails, all those sort of things. We definitely do Twitter. X is a great source of leads of just people that are sharing what they're working on. So I think it's a variety of different things. Honestly, there's no one thing. But yeah.
It's okay. You can still call it Twitter.
Yeah, I mean it's a highly network-driven industry, so people, relationships. I think how Sabrina put it. I mean, we really think about key institutions that we want to build relationships with, whether it's academic institutions or sources of talent where we think future founders will spin up from. We want to build relationships there, and when you're doing pre-seed and seed investing, the reality is that you see a founder who's changed their job history to stealth, like the deal's done. And so when they eventually announce and say, "Here's our company name," like that's because the deal's done, and you're too late. And no one gets credit for being too late, right? So you have to, it's very networked.
Thank you. Any other questions?
AI is a big theme right now, obviously, or it's what's hot. And I know students are kind of like the number one adopters of AI, from what I understand. What's your take on education tech right now and AI adoption?
I think it's a great question. So I think AI is going to recreate how we think about learning, and I think that's one of the really interesting and beautiful things about it is historically you may have had content for your classroom taught in one very specific way. I think with AI today we can actually learn how people sleep. We can learn if they have maybe some way of communicating that could be changed. It could be more personalized to you, to that end student. So I think there's a lot of really positive things that we're seeing in the ed tech world. It's not just one course curriculum, it's a bunch of course curriculum, and I think we'll see that to other verticals as well. I think with any seismic shift, you think about the internet, maybe people would have said the same thing back in the day, is that you can just go to Google and search for the answer, and that's also an issue. So I know there's a lot of things that these model providers are trying to do around making sure that there's ways to show when you're just copying and pasting information from one thing to another. It's the ability to show your work, those sort of things. So it'll be interesting to see what new technologies come out of it. But I think in the education context specifically, I'm really excited about all the personalized learning that will happen in the next few years.
Yeah, I mean, from a research perspective, it's ridiculous, right? What you're able to do with Perplexity, for example, right? So my son just graduated from college last year, and he was, using some of the early chatbots at the later stages of his college career, and was finding, he was able to dive go more deeply rather into topics that he was able to do. So I thought that was great, fantastic tool, and I think it really presents, disruption opportunity for schools in the world, right? At the same time, right, the thing is I think about it, I'm thinking about it not as an investor, but more as a parent, right? And to your point, it's like how do you stop kids from getting in the system? Kids are getting smarter and smarter and smarter. You got to be. 5 years ago they were getting keyloggers to make sure they can find out what their parents put their passwords at to get access to different things, right? Now it's like you've got AI who can basically do all of these different things for you. So how do we make sure that children are actually learning something and not cutting and pasting? Because at the end of the day, if we stop learning the skills that we need to learn that actually created what is AI today, we're in a lot of trouble. And I know that the Anthropics and others are looking for ways to be able to mitigate that, but I think we have a long way to go to address that mess.
You have to be able to actually do the analysis. Anyone else?
Thank you. I'm kind of curious. to learn how you guys think about the fact that, think about Silicon Valley, there's so many big companies, like big startup, AI startup, and they started 2 years ago, now they become $10 billion valuation company. And there are many of those, right? But I mostly just hear any of those in Seattle is because, so what do you guys think? Is it because of Seattle rains too much, or because we don't have Stanford, or because people don't invest? But the thing about like the seven biggest stock, right? So we have Amazon and the other side. It's not bad, but we don't seem to have 2 out of 7 in terms of those big AI companies. So what do you guys think?
Yeah, I mean, it's a great question. I'm sure we all think about this often. I would say that there's a lot of really intelligent, smart people in Seattle. We'll get to all the big tech jobs that we have, and there's actually a strong founder ecosystem in Seattle as well. But I would say one of the differences is that in SF you've had a bunch of unicorns created, you've had a bunch of exits, IPOs in the last 2 decades, and I think Seattle is really waiting on that maturation to happen with the startups in the ecosystem that we have. Because when you have unicorns that are minted and you have these phenomenal exits for all of the employees, and it presents a windfall from an earnings standpoint, then that creates the next batch of founders, and the next batch of founders who are going to go out there and head up with risk and want to start their next large business. And so I think we've got some very good, strong, promising companies that I think are in the exit pipeline, and I think when that happens, we'll start to see a bit more of that founder company creation. But it's there.
I would say we're much more pragmatic up here. We have less of a shoot the moon mentality, I think, in the Northwest, both from the founder as well as from an investor perspective. I know back in the early 2000s when I first started, my leads came from the Valley because they were a little more visionary, they had a little more risk tolerance than, say, the investors up here. That's changing, that has changed, but it's going to take us some time. We don't have the Barker channel, or necessarily the Snowflakes, and all these other companies that come out of Silicon Valley. Yes, we're the home of Amazon. Yes, we're the home of Microsoft. We're the number 4 AI hotspot in the world. But until we start getting that kind of flywheel effect going right, it's going to take some time. But we are absolutely on our way. I think we're going to get there sooner than we think. But that's just been basically the history of venture in the Northwest.
All right, give it up for our Seattle VC panel.